Hey, let's quickly talk about why I think Chinese equities might not have bottomed, even though there have been a lot of investors on different investing forums, on YouTube channels, on different LinkedIn posts saying that, oh, the bottom is here, the bottom is here. And let me just explain to you my position on why I think Chinese equities might not have bottomed. It might have, it might not have, who knows. There's still quite a lot of time. And one day in the stock market is like 1 year in my life. It has never been so eventful. So with that, remember to smash the like button. Don't subscribe if you don't want to. This is just me sharing my opinion on the internet. So now, there's this recent article that was released on Yahoo Finance saying that many firms are underinvesting in China. So just a side note, I don't exactly know why people like to address Asians by their family name or their surname. You always call people Li, and in this case, a lot of people like to call me Tay. I'll prefer you calling me Chee Keng because that's how majority of the people actually address me. And in this case, I believe that the CEO is actually called Kyew Song, so I'll just address him as Kyew Song instead of Lee. So Kyew Song, speaking on Wednesday at Bloomberg Invest virtual conference, said that while the region has always had short-term bumps, the conversation should be about the best way to invest in China and not whether to invest in China. I think generally speaking, someone like him with this kind of experience and this kind of status will probably be able to glean an insight or two, just like Ray Dalio, into understanding how and where to best invest in China. And for those of you who don't know about Carlyle Group, Carlyle Group actually do have a total asset under management of around $276 billion, a billion with a B by the way. So yes, he's not some random guy on the internet like me, and let's see exactly what he has to say about investing in China. So there's more opportunity in that region of the world than not, especially since valuations have corrected a bit. I think this is in relation to the entire big tech crackdown, and there's a lot of valuation reset in terms of understanding, comparing broad indices as well. So if you were to look, the year-to-date performance of the S&P 500 is in the ballpark figure of around 18 to 20%, while the Hang Seng Index, the A50 Index, the performance of all these Chinese-related equities indices have been lackluster, which in this case, if you were to really look at it from a valuation standpoint, I did alluded to the fact that by having huge amount of growth in a very short period of time, essentially just means that you are robbing future growth. And in this case, if the fundamentals and the valuation of the companies underlying do not catch up, there's only one of two scenarios that will happen. Number one, the valuations come back to reality and come back to earth, which also means that there might be a painful road ahead where valuations start resetting. And in this case, the Chinese equities have resetted a lot of their valuation. Or number two, valuations remain high while the underlying companies and the underlying business fundamental actually do chase up to this valuation. But in this case, despite holding great companies, the valuation of all these companies will probably stagnate. And that will also be reflected in your portfolio by having a stagnation in terms of your portfolio growth, especially when the companies do not even give dividends. So there really isn't any forms of cash flow. Now, Kyew Song also emphasized on the idea that the mindset needs to be one of a very long term, to be consistent and to be committed. I think this has been largely been in line with my own investment thesis and my own advice, quote unquote advice, to a lot of people who are interested in the Chinese equities market. I'm not here to tell you which Chinese equity particularly will outperform, whether it's Tencent, Meituan, Alibaba, or even some key focus on the agenda of the CCP, like ESG investing, for example. So ultimately, investing in China requires a lot of patience, a lot of time, a lot of commitment. You need to do your homework, you need to understand a lot more compared to just investing by and large. But I'll just like to say that I fundamentally believe that your homework will pay off in the coming decade or so. Now, in Tuesday's session, there are representatives from Man Group and Soros Fund Management stating that they are not putting any money in China right now. Also on Tuesday, Blackstone's president John Gray said that China will continue to grow faster than the developed markets. They've got a very entrepreneurial culture. They've got a government that wants economic growth to improve quality of lives. And I think that means, broadly speaking, that China should do well. I think this has been hugely discounted. Many investors investing in China just want the companies to do well. They don't care whether there's GDP growth, they don't care whether the people of China is being taken care of, they don't care about whether the system is well governed or not. Ultimately, investors just want to earn money. But right now, there's a huge amount of uncertainty investing in China. They don't know what the government is thinking about. They see that there are so many draconian measures being put in place. They see that the government is not playing by the same rule, which is also why many essentially just pull the plug and just don't want to be associated with the Chinese government and with China by and large. And to me, this is a gross misunderstanding. If you want to diversify your portfolio, if you want to invest in emerging markets, China can never be excluded from your portfolio. If all you want to do is continue believing in the narrative that a lot of the people out there is continuously propagating, please do so. I'm not stopping you, and you don't have to listen to me. But for those of you who are a little bit more skeptical, a little bit more critical, I think this is a huge opportunity for a lot of the investors to reap the benefits of doing your own homework and doing your own due diligence. And last but not least, just a few highlights from Kyu Song. He said that a little bit of inflation is not the worst thing in the world, and we are very focused in on it. I'm much more worried about the impact on interest rate and the valuation multiple. Certainly, asset prices are incredibly high. I think this is always talking about this and central theme on tapering and this entire interest rate environment. Of course, the stock market is forward-looking, and we all know about this impending doomsday, about this increase in interest rate affecting the discount rate on businesses in terms of the valuation model and in terms of understanding the intrinsic value, which is also why a lot of people like to say that, hey, markets always go higher, right? Yes, if you take a 20, 30, 40-year time horizon. But I also like to say that, hey, valuations do matter. So for those of you who are investing in high growth companies, for those of you who are investing in tech companies, please make sure to manage your position size, don't overexpose yourself, and realize what is the current valuation of all the companies in your portfolio. Are they overblown? Are they being traded at a fair value, or are they undervalued? It's up to you to decide. But as an investor, one of my core philosophy is that valuations always matter. Now, as I discussed in the starting of this video, why do I think Chinese equities has yet to bottom? I think on two main points. Despite a lot of huge investors coming out saying that, hey, a lot of people are under-investing in China, and some of them essentially just cut off all their entire exposure in Chinese equities by and large. But that said, on the flip side, there are still quite a lot of investing firms or funds out there that still has a sizable exposure to China and haven't exited. So in this case, a lot of all these huge funds are still kind of propping up a lot of all these equities prices. So who knows, in 2 months' time, many things can happen. And for those of you who have been holding the bag, you know that the last 3-4 months have been extremely excruciating. And in this case, who really knows what the new regulations that are going to be put in place by the Chinese government to help restrict all these different business developments. So with all these funds propping up the price, if all of them start leaving, then yes, we might really achieve the bottom of all these different Chinese equities. And on point number 2, on price targets particularly. So let's just quickly look into some of the forecasts for some of the Chinese equity stock. And let's just use the all-time favorite of this channel, Alibaba in this case. So if you do really look into tip ranks, you can see that out of 27 ratings, 24 rate buy, 2 rate a hold, and 1 rate a sell. And just look into the 12-month forecast. The lowest forecast is at 190, the average is 246, the high is 330. And the current share price of Alibaba is actually at $165. So talk to me about a margin of safety. It seems like the general consensus surrounding Alibaba stock is definitely a buy, because most of the projections by all these different analysts on Wall Street is that there really is no downside. Even the lowest downside is still higher than the current price. Of course, there's this idea of opportunity cost, but let's not go into that discussion. Let's just intuitively look into the business and the stock price itself. There seems to be a huge margin of safety. Now I just go on to Wall Street Journal's market, and let's look at the analyst rating for Alibaba Group. 3 months ago, 47 buy, 6 overweight, 3 hold, 1 underweight, 0 sell. Currently, 40 buy, 7 overweight, 5 hold, 0 underweight, 1 sell. Ultimately, the entire consensus surrounding so many different analysts covering Alibaba stock still has the overwhelming vote of asking people or asking investors to plowing money. But that said, it's not hugely reflected in the share price itself, because as you all know, Alibaba's share price has continuously been plummeting. 220, 200, 180, 160. The lowest was hovering at around 130 because of some strong support. But anyway, as you can see, sentiment surrounding Alibaba stock still remains relatively healthy. There are still quite a lot of buy ratings. But it's just that the stock price is not moving in tandem with all these different expectations. I'm not going to act all smart and confident and tell you that why is there this discrepancy in terms of all these analyst estimates and in terms of why is the share price not moving. But I'd just like to say that in order for a stock price to truly bottom, that's when the entire sentiment surrounding the entire company is extremely bad. When you see that the general consensus of analysts for Alibaba transits from a buy to a hold, or transits from a buy to a hold to a sell, that's when you know sentiments really hit rock bottom. And that's also when we probably will see the bottom of the stock price itself, because people essentially just throw everything away. And in this case particularly, you can see that in this time frame, there's a huge discrepancy. A lot of people still remain extremely optimistic and hopeful for Chinese equities, but yet at the same time, the share price is not showing the signs of strength, and it's not showing and not reflecting the reality of those expectations. And I would just like to say the upcoming earnings call in November will be the nail in the coffin. It will be extremely instrumental and pivotal in changing the different sentiments or estimates of all these different analysts. If they continue posting tremendous results, the expectations will stay, while the stock price will actually start catching up to the reality. But on the flip side, if they post devastating results, if suddenly the growth rate slows down to 15, 10, or even 5%, and that's when there's this huge shift in sentiments, huge shift to pessimism, and that's when you can see all these different analyst ratings start going down from a buy to a sell. And that will probably be when we hit rock bottom for Alibaba. So in this case, please leave in the comment section down below, when do you think we'll hit rock bottom? Have we hit rock bottom, or are we going to trend even lower after the earnings call? With that in mind, I'll see you in the next video, but more importantly, I'll see you on the moon. Goodbye!